Let's get into everything moving markets today. Hi, I'm Brady Hansman. I'm with Guardian Financial, and welcome back to Finance in Focus. Starting with the scoreboard, the S&P 500 is at 7,774, up 0.25%. The Nasdaq at 26,730, up nearly 0.5%. The Russell 2000, that's the small cap index, is the strongest mover, up 1.3% to 3,056. The Dow is the outlier, down 0.7% to 53,589. So right off the bat, this isn't a market moving in one direction. Small caps and tech are leading. Blue chips are lagging behind. Yahoo Finance has a headline out today that explains part of why. The Dow, S&P, and the Nasdaq are wavering as investors wait in retail earnings. Retail earnings matter because retailers sit close to the consumer. The results are one of the clearest signals we get about whether people are still spending or pulling back. Now, let's talk volatility because there's a headline we're sitting with. CNBC reported today that the VIX, Wall Street so-called fear gauge, just hit its 2026 low, sitting at 15.04. The VIX measures how much price swings the markets expect in the near future. A low reading means expectations for turbulence are quite right now, but CNBC's framing it's direct. Don't get too comfortable. Historically, stretches this calm don't tend to last because low volatility often builds up right before it doesn't. That's not a prediction of what happens next. It's just the pattern the data tends to show. Moving to bonds, because this is where things get more textured. The 13-week Treasury bill is down 3.7%, but the 10-year is up to 4.7%, and the 30-year is up to 5.28%. When short-term rates fall while long-term rates rise, that's called a steepening yield curve. It typically reflects the market pricing and different expectations for the near term versus the long run. Maybe more growth, maybe more inflation risk further out, even while near term rates stay softer. Commodities and currencies are telling their own story. Gold is up over 1%, sitting near 4,461 an ounce. Crude oil is down 1% at 82.44 a barrel. The dollar index slipped into 99.43, and Bitcoin is essentially flat, up 0.33% at 63,016. Gold moving up while the dollar moves down is pairing worth understanding. Gold is often priced in dollars, so when the dollar weakens, gold becomes cheaper for holders of other currencies, which can lift demand. Now to the headline, shaping the bigger picture. Reuters reported today that China's economic recovery is sputtering. Both consumption and output are losing steam. That matters well beyond China's borders because China is one of the largest consumers of raw materials and industrial goods on the planet. When its demand slows, it can ripple into commodity prices and global growth forecast. MarketWatch published a piece today on what it's calling the AI productivity payoff. The idea that as companies adapt AI tools more broadly, that adoption is starting to show up in actual earnings and output, not just in headlines and hype. It's theme worth watching as more companies report results in months ahead. In corporate finance news, Bloomberg reported that Alphabet is seeking $3.6 billion in its first ever Australian bond sale. That's Alphabet, Google's parent company, raising debt in new market, which is one more data point on how the largest tech companies are financing their operations and expansions right now. And on the legal side, NPR reported that Meta is heading to trial in case centered on kids and social media addiction. It's being described as a landmark case, and the outcome could carry implications for how social platforms are regulated going forward. Something worth keeping an eye on given how central these platforms are to the broader tech sector. One more worth a mention. Fox Business reported that Harvard has made a $2.2 billion investment tied to Elon Musk's SpaceX. It's a notable example of how large institutional endowments allocate capital into private companies. Reported here strictly as what happened, not as any kind of signal for how anyone else should be positioning. So pulling it together, the surface of market look calm. Volatility's at low. Market indexes are green, but underneath that, you've got a steepening yield curve, a slowdown in China's economy, and a fear gauge that history suggests doesn't usually stay this quiet for long. None of this is to call a panic. It's simply the picture as it stands today, and it's worth understanding the pieces rather than just the headline number. As always, this is market education, not investment advice. For decisions specific to your own situation, that conversation belongs with a licensed professional who understands your specific goals and dreams.